All right. Good morning, everyone. Thanks so much for joining Michael and I today. And we've got a bit of a different discussion rather than our regular market update. We thought we were going to have a bit of a retirement income planning discussion, as well as something that's been sort of top of mind for many people, which is really looking at, trying to get to the agenda here, protecting our identity. There's a lot going around the financial services industry, so we're going to talk about that and people's identity being compromised and just internet security and all of that. We're going to dip into retirement planning, and the big thing with retirement planning is the CPP and OAS, and when do we start that? It's a question we get very often, and it is very specific to each person. So we always run through a financial planning practice to really get an idea specific to the individual that we're talking to. Then we're going to look at our Continuum Income Advantage, which is really about sustainable income in retirement. And, the market correction that we just went through with COVID is a perfect example of why we do that. And then a very quick market update is what we're going to look to do. If there's any questions along the way, feel free to stop us as we go and interrupt or put it in the chat. Michael will be watching the chat as well as chatting with us today. And we would love for it to be more interactive rather than less. So definitely encourage your questions and feedback.
Yeah, so the first thing we'll be looking at, I think with recent times in the investor kind of breach the last couple of months, is looking at internet security best practices, right? So just some general tips and tricks is never click on a link you are not 100% confident in. A lot of times they seem very real, very accurate, and they'll come from a known company like TD or one of your financial institutions, a law firm. And just like, if you're not sure of it or you're not expecting it, never click the link and never open an attachment unless you are expecting it. Never open a found USB drive. Some people, they pick one up and they try to put in the computer to see, oh, who's the person who lost this? Do not do it. A lot of times there is a malware in there that is meant to hack your computer. Also, never give out your information to someone calling you over the phone. Again, if it's just a random call, we happen to call you if we do need information, because we don't want you to provide information like your social insurance number through an email or any written communication. So again, the main key is if you're not expecting something, do not volunteer information. Never repeat passwords, which is, I know, very hard one, which I feel probably everyone here does do. But the main way to kind of get around that is we use one password, which acts as a vault. So you can have one secure vault in there, and then that will track all your different passwords. And then I'll also give you suggestions. So with some sort of long password that no one can remember, I don't remember any of my passwords because they're all in that vault and I don't need to worry about it. This can help reduce kind of that redundancy of multiple passwords for memory. They also think talk to elderly parents. These are typically the most susceptible people to kind of getting scammed. They want to trust when they get those CRA calls or someone from their bank calls them. They kind of are, oh, okay, I trust this institution. I'll volunteer my information. The last one is always use a credit card when shopping online. There are a lot of frauds online, especially if you're on social media, and there's those different kind of shopping malls where they're only online exclusives. If you do happen to have fraud on that purchase, there is protection built in.
Yeah, I mean, these are all really practices that we try to adhere to keep ourselves safe. I mean, a big one for sure is the never repeat passwords and the one password, using the password keeper. And the reason for that is, a lot of times people will use a very easy password that they repeat all the time, and they'll use it across a bunch of different websites. And if you're going to do that, this is a big if. The key there is if you have, say, your social media accounts, you have Facebook and Instagram, for example, don't use the same password for your social media accounts as you do for your financial accounts. Because what happens is your social media account gets hacked, and then they will then take your username and that same password, and then they'll go try the banks. So if, again, a big if, you shouldn't do this, but if you're going to repeat passwords, keep all the highly secure ones that you would never want compromise, like your CRA, your banking, and those ones, all the same. And then the social media, it's yeah, it's upsetting and frustrating, but certainly not as big a deal as your bank getting compromised. So just really, these are what we look to live by. We really reinforce this all the time here in the office, because those are the sort of things that absolutely get people sort of in trouble. So this, coincidentally, I got this yesterday, and you can see this is a perfect example. There's an ongoing fraud trend you should know about, and it's companies, well, fraudsters, or what we'll call bad actors. And they call, and really what they're doing is saying that you have an issue. And this speaks to the one bullet that says, don't give your information out. So if someone calls you, they should have all your information. They're calling you. And it's funny, I kind of play with these people because they'll call me and they start asking me for stuff. And it's like, well, you should have my information, right? So here you look at BMO, they're never going to contact you with a phone call, email, or text asking you for your verification code, user ID, PIN, or card number, or answers to your security questions. But this is what they'll do, right? So the fraudsters are the bad actors. They call and they say, hey, we just want to, clear up your account. You have an issue. We just need your verification code. You say no. Like I've had legitimate companies, and I know they're legitimate, calling me, and like they asked me to verify like my cell phone number. And I'm like, you called me. Like, I'm just not doing that, because I just never will take that chance. The other thing that you have to be careful of is clicking links, but also see here, it says contact us directly. So anytime I get an email like this, if I think it's legitimate, I'm still not going to call the number that they give me. I'm going to look at the back of my card. So either that's my debit card or my credit card, or I'm going to search online for the legit phone number, because this is another very easy way that they make it seem like it's legit, is they say, okay, never do any of these things, but something bad has happened, so just call us and we'll fix it. And guess what? They give you a bad phone number that you then call thinking it's BMO, and it isn't.
Yeah, some common scams that we see all the time, and I used to work at the bank for a few years, so I would see people come in every day for these type of issues, some small, some unfortunately very large. Number one is the example we're going over, which is the phishing scams. So these are the scams that you just saw that BMO was introducing, where they're gonna kind of put a fraudulent link or some phone number, and they're gonna get your personal information. You need to input credit card information as well, social insurance numbers. Anytime sign up an online, I'm going to ask you for any information. That's called a phishing scam. Also, the online purchase scams, which we did already kind of mention earlier. This is again when you're going on some sort of website that you're not familiar with, but they have this really cool product on this amazing sale. You buy it, it never shows up, and now they also save your credit card information that you inputted to buy that. So be leery of those kind of social media heavily advertised stores where it seems like it's too good to be true. Sometimes maybe it isn't, but a lot of times it is. So just kind of do your homework in the background. The one that's really, really bad is the CRA scams. So people pretend to call you as CRA. And this is the one we see most typically with elderly people. They will tend to be the CRA, and they say, you owe X amount of money on your back taxes. We're coming to pick it up. And they will show up in a blacked out SUV in a suit, and they will actually come and pick up a check. CRA is never going to actually come to pick up money from you, ever, right? They will not. They will send you some sort of thing on your CRA account or on your tax report, and it will say you owe it by this time, pay it at these intervals, or they're just going to charge you interest if you don't pay. They rather you pay more over time. So anytime CRA calls and asks for money, it is not actually the CRA. And again, if you do have elderly parents, please make sure they are mindful of this, because it sets that panic that, oh, I owe taxes. They have that perception that they're going to end up in jail if they don't pay it, which is not the case in Canada, but they get really scared and they end up writing multi-$1,000 checks. And then they'll actually come back a second time. Once they know they have you, they can say, oh, we made a mistake. You owe an additional money, and they're going to keep coming back. So please, that's probably the number one major one we see with phishing scams, be the most common. Tech support scams as well, very similar to phishing, where scams are going to contact you. They're going to say they're from some sort of reputable tech company, and they're going to ask for verification numbers. Again, anytime someone asks you for information that reaches out to you, don't give them information. They should have it already.
Yeah, and this one I have a personal experience with. 2 weeks ago, a client had this happen, and basically what they do is Microsoft, well, not Microsoft calls, but they say it's Microsoft calling. We know there's a problem with your computer, so we're going to help you fix it. So we're calling from tech support. Click on this link, share your screen, and then basically they get in, they install some kind of malware tracking software on their computer, and then they say, okay, you're good to go. And then what they do is they track everything that you do going forward. So that would be all your passwords and bank account information and all of that stuff. And then they pretty much have everything that you have on your computer. So that's definitely a scary one.
And the last one is a lottery and sweepstakes. So I get emails all the time saying I won money, or a lot of times it's someone pretending to be extremely wealthy from another third world country, and they say, if you just lend me $1,000 that I need to unfreeze my bank account, I will send you $10 million. That is not the case. Most people probably seen that, probably rolling their eyes knowing it's not true, but people do fall for it all the time, and they think they have some sort of prince coming to save the day for them.
Yeah, and the last three in particular, definitely important to discuss with elderly parents. These are the ones that they really get caught up in. So just be careful with those ones for sure. So protecting your identity, many of you heard of the investor.com or Go Anywhere, the incident that happened. Mackenzie was actually quite good with reaching out and letting people know that this has happened and providing some additional coverage. But other companies, as well as the City of Toronto, you can see there in the middle, have been impacted. So Procter & Gamble, Rubrik, Canada Life. It is a really big incident, and unfortunately that's good news and bad news. The good news with that is that if your information was compromised, and that's with like literally millions of Canadians, the likelihood of them coming across your information and wanting to use your information is pretty low. So to me, that's a good thing, is like, you know, you're kind of hidden in the masses. And I mean, Mackenzie alone is, you know, has accounts for millions of Canadians. So you add that on top of the City of Toronto and Canada Life, like we could literally be into the tens of millions of people.
And then some more tips to protect your identity is if you were signed for a credit monitoring service like Chinese Union. So if you were part of that Mackenzie breach, they're actually offering you 2 years of free coverage. And if they find out kind of people are being compromised beyond what they initially reviewed, they are open to continuing that coverage. We have tried to negotiate with them to get 5 years. At this time, they're not willing to offer it, but it is something that we will definitely keep you in the loop on. The second one is the Equifax Complete Premier. So this helps you monitor your credit and provides a robust identity theft protection plan. So where TransUnion is just going to kind of monitor if something goes on, Equifax will kind of take it one step deeper. And then it also will alert you if key changes in your credit are done. Another one is contact June from our office. She used to work for Service Canada and has seen these breaches on a regular basis. So she has the whole textbook of how to kind of go about it if any of your information is compromised.
And the Equifax one in particular, I've used for years. I signed up for the TransUnion one through the Mackenzie offer. Yeah.
That was part of the breach.
Yeah, me too. But the Equifax one I've had for years. Definitely what I like about the Equifax one, and why I encourage, even if you got the free TransUnion, I still think paying for the Equifax is worth it, is because if anyone is trying to do a credit app or any sort of you know, open accounts or credit cards or anything, they go through Equifax and you get notified of it through that Equifax monitoring service. So I definitely think that one is worth it. So then we have the home equity line of credit is something we talk about quite often. What these bad actors often look to do is they look for mortgage-free homes, and then they go and stick on either a home equity line of credit, or they take out a traditional mortgage. And the thing is that if you already have a bank or a financial institution in first place in terms of like a home equity line of credit, then it's actually harder for someone to come in and put another debt, so another mortgage or line of credit, in second place, because they actually have to go to the first place one and get confirmation that they can do that. So even if you are mortgage free, and even if you have no reason to need a line of credit, we still encourage people to do it. Unfortunately, there is a cost often when you walk up to the bank and you're sitting there mortgage free. They say, well, if you want to do that, we need, you know, to have your home appraised and all of these things. I don't know. I still think it's likely worth doing, and argue with your bank and see if they will do it at no charge. But that's definitely, you know, a first line of protection against people putting a mortgage against your property or opening up credit cards and doing things like that. Side drawer, this is something that we've now been using for a couple of years. As you can see, 95% of the time it's email-based information exchange that gets compromised. So when we use side drawer, all of those personal and confidential and private documents are all going through a very secure. So side drawer is using bank level security, and it is highly encrypted. And that way we don't have any of that secure information flying back and forth through email.
So the next step is now we talked about the data security. Again, please, if there are any questions, don't need to wait to the end. You can instruct anytime. Again, I am still monitoring the different applications and also the comment section. So please, if you have questions, let us know. Even if we moved on sections, just send one and we can go back.
So essentially what we're showing you here is the actual financial planning or retirement planning software that we use every single day. And what this is looking at is cash flow for this couple, and essentially they're 63, starting retirement income at 65 with 106,000. And basically you can see their cash flow, and it's increasing with inflation every single year. And then we can see that R shows up at age 94. So this shows us lifestyle deficiencies. So they've run out of money here, and they have $97,000 shortfall. And with inflation, that's $250,000 is their lifetime goal. So we look at this and say, okay, well, we started our CPP and OAS at age 65. And this is exactly what we do with clients. I just did one yesterday. This is exactly what we do with clients when we're like, well, what is the right answer for you as an individual in terms of when you should start CPP and OAS? So I'm going to flip back and forth. These are called concepts, so we're able to save it. So it's exact information. And all we've done is drill into the details and change the CPP start date. So here we can see that the bars now start purple bars, government benefits now start at age 70, and the red bars are gone. So that's your kind of first indication. But we always like to take it a step further, and we look at this chart, shows us financial assets. So this family or couple is sitting at $1.2 million, almost $1.3 million of retirement assets. They have a small cash account of $190,000, and they have a house worth $1.5 million. So you can see over time, as they're drawing down those retirement assets, here under the scenario of starting CPP and OAS at age 70, they're burning through the retirement assets between 63 and 70 much sooner, because they're using up their own money to offset not getting CPP and OAS. But as you can see, it actually lasts now all the way to age 98. Whereas if I flip back to the other scenario of starting CPP at 65, so again, we look here, it starts right at 65. We see the red bars show up again. And now we look at financial assets. Here we see that basically now, same timing, we've run out of money at age 93. So it's a really good example of how much of a difference it can make when we defer taking CPP and OAS. And all the time, we will get clients that say, oh, my brother-in-law, my sister, my other, the bank advisor is telling me I should take it right away, even at age 60, let alone age 65. And what we've always said is like, listen, like at the end of the day, it's worse for us if you defer it till age 70, because we get paid very simply by how much assets you have in your account with us. So the more assets, the more we get paid. That's called the F-class trailer. And essentially, when you look at that, if you start drawing down your income and your money faster, then we will get paid less sooner. So if we're telling you it's better to defer and not start CPP and OAS until age 70, then rest assured it's in your best interest. Now, the only caveat to all of this in terms of when is the best time to start is life expectancy. And half jokingly, people say, well, really, when is the best time? I say, well, you tell me when you're going to die, and I'll tell you exactly when you should start your CPP and OAS. But joking aside, age 82 is really that break-even point. So if you get past age 82, you live past age 82, then you won by deferring and waiting until age 70. If you pass away sooner, then you should have started CPP and OAS sooner. The other thing that's interesting is that when we look at that CPP and OAS discussion, if we look at this planned retirement, again, for this couple, we have them planned to have $100,000 a year after tax income in retirement. And this is telling us that they have a shortfall. So they're actually on track for only 95. Now, if I flip over to deferring the CPP and OAS again, we can see how that recalculates. And now they're actually right on track. And the portfolio rate of return is at 5%. The required rate of return is basically the same. And we can see here their projected capital at retirement is 1.6. So this is the sort of work that we do when we get asked that question, because everyone's situation is completely different. There is no, standard rule of here's what you do all the time. And, that's one of the main things of why we've always been very early adopters. I mean, we've been doing full financial planning essentially the entire time here at Continuum 2. So I've been doing it for 2 decades, and my mother before that. Really, that's why is like, we don't want to guess at things. We don't want to, have assumptions. We want to put it into the financial planning software and see what is it actually telling us.
Yeah, so Peter did a great job of going over kind of the actual financial plan, what we'll do. And again, but to everyone's situation, it will be completely different. The standard rule of thumb, without kind of any deep dive analysis, is to retire with 70% of your gross income in retirement. So what that looks like is, say you're making $100,000 during your working years, you should want to retire with $70,000 in retirement. Again, it's not for everybody. For most people, the assumption is your mortgage is paid off, there's no debt payments, and you don't need the same lifestyle expenses. But for people who maintain a mortgage or are renting, those expenses do not write off. So it's not saying, oh, it's a one shoe fits all. Or for other people, they say, hey, even though I have my mortgage paid off, I want to travel a lot. I want to buy these new things. I want to kind of live a higher lifestyle now than in retirement. You might need more than 70, or again, you might need 50% depending on your lifestyle. So this is kind of a chart just to show like a general rule of thumb. And we can see that where it shows that the blue and red lines, or pink, depends on your screen, is the government pensions. That's old age security and Canada Protection Plan. And you'll see that those, no matter when you start up, is definitely more than likely going to be a shortfall. And that's where personal assets from either work plans or your private plans will make up that shortfall.
We are running a little bit long, so I'm going to pick up the pace a little bit, but if there's anything anyone wants us to double back on or slow down, let us know. This is just really reiterating what Michael just said. When you look at sources of retirement income, it's split between public plans, personal investments, and other savings. So the public plans, CPP and OAS, really are the foundation of everyone's retirement household.
Yeah, this is showing that the max CPP is 1307. Old age security is 688, but the average, so that's an average of $24,000 a year at age 65. Taking it again, as we'll see in this, there's 24,000 a year doesn't get you very far, and anything expenses. And most people don't even qualify for the max. The average in Canada is just north of $15,000 a year.
So when we look at old age security, really the important things is automatic enrollment. So at age 65, it automatically starts. So you can stop it. And really, you need to call and let them know that you don't want your CPP started. Your old age security started. And the clawback is also an important piece. So if your retirement income is between 79 or just above 79,000, they start clawing back. If you hit 129, then it's 100% clawed back.
Yeah, and this kind of shows where Peter's talking about the break-even point at age 82. So if you took it at age 60, your CPP, if you had full, was $836 a month. You see, if you die at 72, you are ahead by a little bit by taking that 65 over 70. 82 is the break-even point, but by taking that 70, you get $1,800 a month. And that's because it's index of 8.4% per year. So that's a guaranteed every year you defer it, it's going to increase by 8.4% per year. So it's not like you have to do 65 or 70. You can take it at 66 in 2 months in, right? It'll index by 0.7% every single month. And that's guaranteed for life. So that's why we tell people, like, your investments may have averaged higher than that or lower than that, but it's an expected rate of return, right? But this CPP and old age security, they are a guaranteed index. So it's guaranteed going to be 8.4% per year for CPP to defer, and then 7.2% per year for old age security. But on the counter, it also reduces by 7.2% for CPP if you take it early. So that's guaranteed income for life that you're either increasing or decreasing.
And basically how this chart works is kind of confusing at first, is essentially if you die at 72, this one is circled because you got 120,000, that's the highest amount, versus 109 versus 44. On the other hand, if you die at age 85, you get 250,000 starting at 60, you get 313,000 starting at 65, or 333,000 if you wait until age 70. So Continuum Income Advantage, this is something that we developed many years ago. And really the idea is that if we look at, this is quite a complex chart, I'm not going to go into any detail, but really it's how complex it is, and portfolio construction isn't easy, and things are moving in all different directions. So really the idea behind this is, how do we smooth out those bumps? How do we get to a point where you're taking retirement income, but the retirement income that you're taking is not floating with the markets, it's not going up and down? So if we see here, we have a growth of $10,000, and we have growth of $10,000, and we're comparing two different portfolios, balanced portfolio versus a growth portfolio. So really the idea here is that ultimately over the long term, we still need to have gains. We still need to get, a 6 or 7% rate of return long term. But the key is we can't have all your money doing that. We can't have all of your money invested, because if you're in a balanced or growth portfolio and you're taking retirement income out of it, and you're taking retirement income out of it in a year like we've had, where we have negative numbers, or even worse in 2020 where it's down like 30%, and you're still trying to draw out $100,000 a year to live on an income, I can tell you that's a problem, and that eats into your long-term ability to sustain that income right until age 98, which is where all of our financial plans go out to.
And that's why we want to look at asset allocation. It's probably the number one most important part in portfolio construction. People always want to chase returns and have the highest return possible. It's the most important part is not the physical return number itself, it's the risk adjusted rate of return, right? If you're in an all equity portfolio getting 10%, that's great, but that's also going to put you at risk of the market, where maybe last year you could have been down north of 20%. So based on your kind of age and stage, as well as your goal, we really want to build the portfolio around your asset allocation. And then again, not to go all into this kind of breakdown of all the different types, but then we want to have different manager styles, different types of stocks and bonds into it, based on different industries, management styles, geographic is super important. So when we build the portfolios, our number one focus is this asset allocation.
Absolutely. Actually, all of the research and all the studying, if you see my designations, every time I get a new designation that has anything to do with investing, actually they reiterate that every single time. Asset allocation is the most important determining factor of long-term returns, bar none. And it accounts for over 80% of total returns is having the correct asset allocation.
Yeah. And then once we have the asset allocation, we really want to look at each individual fund within it, right? So for example, right now we have the Fidelity Growth Portfolio Series, which we've added to all our models. You'll see it's a 5-star out of 5 on Morningstar. So when we're looking at all the funds, we want to look at each individual fund in that overall portfolio is going to be in that 4 to 5-star range, as well as the quartile rank, which means in its peer group, where does it rank? And we see this Fidelity one, it's always first or second in its class, right? It's a consistent over the long term, which we want. And then we're going to find those winners in every single asset category. So if we need a short-term fund versus a long-term versus international and domestic, we're going to do this deep. And once we have the asset allocation, we're going to take this deep dive into every single fund and make sure we have a highly rated fund, not just from today, but also look at that track record and not just chase the hottest, newest thing on the market.
Such an important one. And I can tell you, being in this for over 20 years now, we use Morningstar. This is what we look at all the time. Most people have never heard of quartile rank, and it is one of the most important things. So I'll quickly run through essentially how it works. As you see the 4 different, they're called quartiles. If it's highlighted at the top, the black section at the top means you're in the among top 25% performing like investments. So comparing apples to apples, risk tolerance to risk tolerance, right? Is it growth versus growth? And then if you look at the second one, that means you're in the top 50%. So you're among the top 50% performing like investments. Now you see in this investment, there is no third or fourth section highlighted. That's a good thing. Now, when you start seeing investments that you have the third and fourth, that means you're among either the worst 50% or the worst 25% performing. And those are definitely the ones that you want to be watching and saying, like, we need to get out of this. So that quartile is definitely one of the most important things that we look at when we're building portfolio construction. Now, this is what we call our Continuum Income Advantage. And really what we're trying to do here is, you see here, monthly cash flow for a sustainable lifestyle. And if you think of this as just 12 months of your, call it allowance every month, and you just keep the numbers easy, say it's $2,000 a month, that's $24,000. Sitting in cash, we'll have $24,000 and we'll pay it out $2,000 a month. Then we'll buy a 1-year GIC and a 2-year GIC. And the reason we do that is that's 3 years of no volatility. So it doesn't matter what's happening with the markets, that if the markets are going up or down or sideways, but the worst part is if they're going down and you're drawing out of the markets, you're in trouble. But when we build this process for all of our clients, you have no issues, no concerns, and no worries about what the markets are doing for a full 3 years. We have guaranteed cash, zero volatility in the income that you can achieve. So the 1-year GIC, we're going to buy just over $24,000 because we want to account for inflation. And then the 2-year GIC, we're going to add inflation on top of the 1-year GIC. So if with inflation, say it's 25,000, this one maybe is going to be 26,500. And what happens is this comes due when the cash runs out, and then this comes due the next year, and then we have a 1 year, and then we flow it down like a waterfall is how I always describe it. So a waterfall going from our balanced portfolio to conservative, 2-year, 1-year cash, and then into the sustainable long-term cash flow that you can depend on. Now, the conservative portfolio is what we're going to use to fund when these 3 buckets run out. When we do this, I can't tell you. Basically, it's based on, I can't tell you when the best time to do it is, but I can definitely tell you when the worst time is. So, you'll look at March 2020, or down 30%. We're definitely not taking out, 1 year, 3 years, or 2 years of cash to fund those future years. We're just going to rely on the cash that we have. And then as we start seeing better returns, and as we start seeing, say, market highs, that's when we'll start flowing money into cash and taking money off the table. And we did this in 2019, and it's funny, I had a couple clients push back and say, Peter, things are going so great. Like, why are we taking money off the table? We're giving up gains. Well, we've researched that as well. And the gains that you give up are nowhere close to the losses that you're going to get when the market corrects. And again, 2020 is a perfect example. So we got very lucky by following our process and being dedicated to our process, because we took a lot of money off the table in 2019 when you're hitting record highs, and you hit record high, record high, record high. Great time to take money off the table. So then what happens, you get a market correction in 2020, and all of those clients had 3 full years of cash that we could depend on with zero market volatility. And then we look at the balanced portfolio. So that, again, like Michael said, is asset allocation. And really, a balanced portfolio, you're looking at a 60-40 split, 60% equities, 40% fixed income. Now, the reason that's so important is we don't need to touch it for 8 years. So if it goes up and down, and it's going to be more volatile because we got 60% equities, that's okay. We have 8 years for it to do those bumps, do those gyrations that it's going to go through. And then as we need the money, like I said, it's going to be that waterfall. And then when we are hitting those market highs, we will take some off the table of balance, move into conservative, take some of conservative, move it into our 2-year, 1-year, and cash accounts. So that's really, the Continuum Income Advantage in a nutshell. And the key is, the main takeaway is, we still need long-term returns. We still need to get those returns. You can't, do like the olden days of buy a bond or a GIC and just live off of that. You're not going to beat inflation. You're going to be losing money, but we still need that consistent cash flow.
Yeah, we see so many people where they come in and they're retired and they have a conservative portfolio only. So all their money's in conservative, and it's an easy rationale to buy into. I'm retired, I need the money, I should be conservative. It's very quick and easy, and probably easier to understand than this, to buy into. And that's what we see people in a lot. And when we say is, well, part of your money is too aggressive, part of it's too conservative, right? You still need those long-term returns, like Peter said. So if you're not touching money for 30 years, right? If people forget, retirement's like a whole nother section of your life. It's not supposed to be for 5 years. It should be 25, 30 plus years as people live longer, and you're going to be trailing on those returns. But also, when you need money up front, even if that conservative profile loses 10%, you're now taking more units out. So this can be kind of a hard example to map out without the chart. But if you see, for example, $1,000 in 1,000 units of the investment, and you take 1 unit out a month, you have 1,000 months worth of withdrawals. If the investment loses 10% in that conservative profile, like last year the conservative profiles did, now you maybe only have $900. So now you only have 900 months of withdrawals versus 1,000. So as you take out from a negative portfolio, you're just draining your assets that much more, because you need more units to take out.
Yeah, and that is the number one issue. And actually, a lot of the portfolios that we see where we come and do that initial analysis, and they're considering moving their assets to us, we actually see a lot of them will have a balanced or growth portfolio, and they're withdrawing. And exactly what Michael just went through is what's happening, and they don't even know what's happening. The other advisor doesn't even know that they're doing this to the client. Like, they're not even aware that that's an issue. And the key is people just look at the money that's coming into their bank account, not really thinking about the value of those units. So one of the next things that we want to do is a quick market update. I mean, there's definitely a lot going on, and I put experts in quotes here because there's really conflicting advice. A lot of people are looking at things saying like they see certain things in one light, and then other people are seeing the exact same things in a different light, or they're focused on different aspects. So you look at what we have here. So we've got Double Line Capital, billionaire investor. I mean, all these are billionaire investors that we're going to reference. And you have key economic indicators, full on recessionary. Absolutely, right? No question about it. And then we have this cliff S-ness. So bonds are pricing in multiple severe cuts over the next 2 years, right? The forecast is for a recession and not a mild one. But then there's conflicting. The equities, on the other hand, are looking strong and good. So we have two conflicting stories here. One is what the bonds are saying, and historically, if we had bonds in this scenario, what would happen with the economy? And then we have equities that are saying really the complete opposite.
Yeah, we keep looking at we go to Charles Schwab, and he's saying same thing. The drama characterizing the first half of 2023, potentially milder returns and recession, right? We see that theme where they think, he says now mild recession but prolonged. And then we have Goldman Sachs, who actually just yesterday changed their recession forecast for 2024 from a 35% chance to a 25% chance. And this is probably one of the largest banks in the world saying this. Deutsche Bank, I know they've had problems throughout COVID, but they're starting to recover. And they say, hey, with inflation, it's going to put some pressure, but then we're looking to return to target in the near future.
So then we have Data Trek Research, obviously focused on data and research, and really what they're looking at, as you can see there, the history does not support the idea that May jobs growth push back. So again, looking at the jobs data, this has been a big thing. We've been talking about actually the jobs data probably in the last two webinar series that we did, because it is a struggle, right? It is a struggle that when you look at the jobs data and jobs number going up or not going down as much as they thought, because there actually has been a couple of pullbacks. That's such a big thing, right? So if people are employed and employers and companies that are looking for staff, and they can't deliver on the orders that they have or the service that they have, it's kind of hard to look at the economy and say, well, we've got a recession looming when everyone is still looking for employees. The key is, though, as I said before, is that there's sort of the different metrics that we look at, and people looking at different pieces, is that when you look at the challenges that we have on the inflation side, and then, with interest rates going up and the impact that's going to have on housing, I think that's where we've got a really important piece that we need to understand, is that there is a lot of conflicting messages. But that really, to me, speaks to the importance of what we do, that portfolio that is a pension style of investing, which is really being diversified by nature and not having all your eggs in any one basket. And I mean, this is a great chart here, Michael, that really talks about, that exactly.
Yeah, exactly. Perfect reason for kind of diversification is I want to take the S&P 500 and the TSX composite. We look at the year to date, which you just put your mouse over so they can see it. So this is pretty much from January 1st to June 2nd. Where the markets have been. And you look at the S&P 500 of 12%, you look at the NASDAQ of 33%, and the TSX, which is the Canadian market, of 4%. We look at them and you say, well, why am I investing any money in Canada? Last year, Canada was the best performing market in the entire developed world. Everyone lost, but somehow Canada lost the least. They were down, I believe, like 3%. And we looked at the NASDAQ down over 20, S&P 500 down over 15. And then this year, NASDAQ's come back with a boom as the tech industries really blossom. And then the large 500 companies in the States has gone up in double digits. And we look at the other parts of the world where some have trailed, some have done well, like Japan's done well. Emerging markets have struggled. So these are more like on the smaller economies. But we say, well, wherever the green lines are, so the green is where kind of who's done the best. And we say, well, it's never consistent, right? Right now, NASDAQ's been amazing, but they were awful last year. So we just made a bet that, we got to take everything out of NASDAQ because they're falling apart. We would have missed that portion of 33%. And if we rode Canada the whole way, we would have been trailing the market this time. So we look at it, one, we see the green, which is a positive sign to show that month so far was positive, year to date we're positive. But 1 year we see some negatives still, some positives kind of starting to switch. The most important part we want to see is look at the 3-year, the 5-year, the 10-year. Outside of the overall Canadian universe, which is a weird kind of metric, everything's positive in that time horizon. So perspective is very, very important. Very easy to get caught up in the red in the short term. When we learn long term, that's where the diversification and the pension style investment really starts to kick in. So that's why we wanted to show this chart. And also kind of a quick update to say, hey, year to date, things are starting to recover and we are starting to see a positive trend forward. Whether that's going to stay or recorrect, again, we're not sure, as we talked earlier about the conflicting advice, but at least we say year to date so far, we are in the green.
Yeah, and these numbers are relatively recent. So that's June 2nd numbers. And, Michael hit the nail on the head. Like, it really is about diversification. What we look at, now we don't have this chart, but there's a lot of charts that show chasing last year's winners or chasing last year's losers. And, that's really what Michael alluded to, was that if you try to chase last year's winners because they were great, you would still be in Canada and you're not going to do that well, or not as well as you could have as if you're just well diversified. And same thing, if you chase last year's losers, you actually, if you bought the NASDAQ this year because NASDAQ was down one of the most, you would be a big winner this year. But actually there's all kinds of stats and all kinds of data that show chasing last year's losers or last year's winners is not going to perform as well as just being well diversified. And again, that pension style investing, what we've followed, as I said, for like 2 decades now, is really about trying to take out those bumps, trying to smooth the bumps out, just get consistent returns. And the key with that is risk-adjusted rate of returns. If you don't get blown up, if you don't get wiped out by big corrections, guess what? You don't have as much to climb back. So if we look at, 2020, the TSX is down 38, our average client was down significantly less than 20. So if you have the markets down 38 and you're down 15 or 14 or 13, guess what? We don't have to double your portfolio to get back to where you were. Whereas someone that just rode the market all the way down a 38% correction, that's a massive hill to climb to get out of. And that is not being well diversified. That's not a pension style investing. And, that really is not a philosophy that we believe in. So that's why we know unequivocally that being well diversified in terms of the asset class, the type of manager, so are they value, are they growth, geographically, is all of those keys is really important to having long-term consistent returns that we can depend on your retirement being as you expect it to be.
Yeah. If you drop 10%, you only need an 11% recovery. If you drop 25, you need a 50% recovery. So the ratios are all in favor of just minimize the down, you need less on the up. Just some final tips before we conclude. I don't think it's going to be relevant for most people that I see in this chat so far, but the new First Home Savings Account is now available on Investia as of Monday, June 12th. It's really been a choppy onboarding to this new account, as the government, CRA, and financial institutions have not been on the same side. But it is a great product for first-time home buyers or people who have been out of the market for 5 years. And what you can do, you do $8,000 contribution for the calendar year 2023. And then you'll get an additional $8,000 to a maximum of $40,000. So you have 5 years worth of contributions. There is no carry forward like a TFSA or an RSP. So if you don't use the $8,000 this year, you don't get it back next year. And it's also a tax deductible expense. So it's kind of a perfect blend between an RSP and a TFSA. But the only thing is there's a singular goal. It has to be used for a home. And so you get tax deduction up front. So as the example, if you make $100,000 a year, and you put $8,000 into the account, you essentially, when you file taxes, only made $92,000 that year. So that income tax you paid from 92 to 100, you get it returned at about 37% there, and then it'll grow tax sheltered. So if that 8,000 goes to 10,000, and you pull 10,000 out to get a house, well, you completely got it tax free, and you take it all out. And unlike the RSP home buyers plan, you don't owe that money back. So over a 5-year period, you and say a significant other each put $40,000 over 5 years, you now have $80,000, which can probably make up a good chunk of, if not all of your plans. So again, even if it's not applicable to you, but people where this can be beneficial, just wanted to let you know that it is live and active. A lot of financial institutions don't have it set up yet, but we know Fidelity is one of the accounts that do, so we can open these accounts.
So thank you, everyone. Really appreciate that. You join us this morning, and if there's any additional questions, we're happy to take them now. I'm going to stop the recording. So again, thank you for joining us, and I hope you all have a great day.